Hi everyone, and welcome to this presentation. It will be my pleasure to talk through this trading opportunity that we have in the Great British Pound against the Swiss franc. Set before you is the monthly chart for this currency pair. There's two main reasons why we use the monthly chart, because it is quite unorthodox. Normally traders just rely on the daily or on the weekly charts. What we can see on the weekly is the general trend of the market. Is this market going up, down, or consolidating? Well, what we can see by this monthly chart is it's broken out of a pennant. The market got above the consolidation zone, closed, back tested the trend line, and rallied higher to close. That is a bullish signal, and we believe that this market over the long term will head higher. The other reason why we like to rely on monthly charts when first analysing currency pairs is because on the daily you could plausibly draw quite a lot of horizontal trend lines, and it can result in quite a lot of noise in your charts, and it can conflict a lot of analysis. On the monthly, a lot of this noise is taken out, and all that's left is the very potent price points. And you can see that we've drawn two horizontal trend lines. I believe that this will act as a band of resistance, but on a conservative basis, obviously there's lots of resistance here that we can't see. It's not appearing on the monthly. You'll see it on a daily and a weekly maybe, but not the monthly. But this is the main target that we have for this currency pair. And on a conservative basis over the long term, I think this market could head towards the 1.381 area, which represents around 5,900 pips of upside movement. That is a lot of movement in this currency pair. And so if we're expecting this market to go higher, we need to look at the daily chart to see about entries. Is this market low enough to buy, and what sort of setup has it got at the moment? Well, we can clearly see on this chart that the trend is up. We put in a high, a low, a higher high, a higher low, a higher high, and if this area holds, we will put in a higher low. Now, it doesn't take much to guess what's happening next. Providing the market holds this area, we should go up and make a higher high. And that is what we're hoping for and what we're trading for on this currency pair. You can see that we've put in a descending counter trend line, and the market closed just underneath that resistance. So it's very important to observe what happens in the next session or two with this market, because what you could have is one of two things. This could drop back to support, or Monday, Tuesday, the market could open, rally through, and we could get a close above this trend line. Now, just because the market is at a low point, we are in the business of buying low and selling high. So we are buying at low points, and on the daily, this is at a low point. But we cannot just jump into this market. This is the difference between us professional traders and people that have very mixed success trading. If we think that this area is going to hold and the market goes higher, that's not enough. We need to let the market show us. We don't want to tell the market. We can't tell the market to go higher. The market has to show us it wants to go higher. Then, as we know that, we will enter the market. So if the market does break up and close, and as a guess, let's just say it closes up here, can we buy the market? Well, we can buy the market, but it will no longer be at a low price. It will have rallied, and if we buy a close up here, there is a risk that what can happen is it transpire to be a false breakout, or in any case, the market could drop against us back down here. This is a very highly leveraged market, as you know, so we cannot tolerate too much adverse price movement because of the drawdown of our account. So one might put their stop loss down here. If the market comes down here, it's going to knock you out of the trade. And if this support fails to hold, then you've bought higher and you're going to sell low. That is the exact opposite of what we want to do. So how do we tackle this market? Well, if this price breaks up and starts to trade above, and you get a close above this trend line, it will be a buy signal, but you will see it happen on the hourly chart first. So if we go to the hourly chart, I want to talk through the strategy that we're going to be using this week. If I zoom out, you can clearly see this is the descending counter trend line that I showed you on the daily chart. The market is quite close to it. We tested it and backed off a little bit, but I anticipate that what could happen is the market might drop a little bit more. I mean, it could drop all the way down here, or it could turn around and rally and close above this trend line. If it does that, it will be in the buy zone. The market is showing us that the bulls are pushing the price higher, and we could be looking at buying. But we want to buy low and sell high. If the market comes up here and we buy it, it could come back down, and then before you know it, we've been left high and dry and bought at a high price, which is the opposite of what we want to do, as already said. So what we do is we look for a setup like this. We will expect the market, whether it goes down a little bit more is immaterial. We want the market to come up into the buy zone. We would buy the market, but it's at a high price. So we will expect the market to come down, maybe test the back of that trend line, and then as the market's going down, you will see it come down for maybe a couple of hours. You'll be able to draw a resistance counter trend line. If the market stays below that counter trend line, we do not buy it. If the market closes above it, so on the hourly candle, we get a close above that counter trend line, that is the point where we buy this market. So just to reiterate, just quickly, if the market gets into the buy zone, we're interested in buying. We want to buy, but we're not going to buy yet. The market comes against us. If the market falls back down here, there is no buy. So we need this market to get into the buy zone and offer us a low price. We know it'll be a low price because we'll get a close above this trend line. And then what we will expect is at least a test of the previous high that I showed you on the daily, but I expect it will go higher to make a higher high. That is the trading setup, and unless we get this exactly as I just stated, we will not be buying this market. So if we go back to the daily chart, if the market fails to break above this and the market drops, will we be losing money? No. If we get the setup that we asked for and we get a close above here and the market goes against us and stops us out, will we be upset with ourselves? No, because we've ticked all the boxes. If you do this trading setup over and over again on different currency pairs, overall you will make money trading this way. We would suggest putting our stop loss below this low where the market U-turned. The reason being is because if this market wants to break higher, it should not take out that low. It should not take out this low. So all the time that the market is above this, we want to remain long until it hits our price target. I hope that you've enjoyed this, and I do appreciate your time. If you could just let us know in the comment section if you took this trade, because it'll inspire us to share more of our trades if we know other traders are trading the same trades as us.